Whereas if you do it the other way around, where rates are rising because there's a debasement fear or there's a term premium fear, it doesn't work the same way for equities. So that's why when you look at rates, you can't just say, oh, rates up, it's bad for stocks. Rates down, it's good for stocks, because it really depends what's driving the move in interest rates.
Yeah, and actually that increase in risk through treasuries could possibly even bring more capital flows into equities because that risk difference starts to shrink.
Right.
So I want to kind of drill in a little bit more on this conflict around interest rates. We have two sitting governors of the Fed board who are openly dissenting with Powell's choice to not cut rates, and they're calling for rate cuts. The sitting president and vice president are openly almost bullying the Fed chairman, right? Calling him stupid to the media. Who's going to win this tug of war, and why are both sides fighting so much over this at this key point in the where we are in the markets right now?
Well, as if you're invested in US equities, you want the Fed to win the war. You do not want the Fed to lose the war to the point where they become a third, an arm of the president's office. That's the last thing you want. Anyone that owns US denominated assets would certainly not want that. Now, there's obviously there's a big hurdle here to understand, because when you have the Fed board or individuals at the board dissenting, the degree at which they're dissenting and what they're calling for matters a lot. Because if you look at it, the Fed dots are already indicating, as per June, that the Fed is going to cut rates this year. It's already the Fed basically is telling you they expect to cut rates in 2025. So rate cuts are coming, and the market is expecting pretty much around 3 to 4 cuts by this time next year, roughly.